I played the soundbite from Bullard earlier about this risk that inflation remains higher for longer and the market is underestimating or underappreciating, I think was the word he used, underpricing those risks. You're a market participant. Are you underestimating and underpricing that risk?
No. Scott, you know I've been talking about inflation, and it's everywhere, right? It's not only rents and wages. It's not natural gas at 14-year highs. Oil prices have stopped going down. Food prices are up 13%. Today, we got the GDP deflator, price deflator, and actually that was up, accelerated from the prior print. It was at 8.9%. So I think they should front load, number one. They're behind the curve, number two. And number three, I did think it was interesting that about Bullard's comments saying they might stay higher for longer. That I thought kind of got in there that maybe people, because people are starting to think, okay, they're going to be aggressive and then they're going to turn around and they're going to reverse and they're going to pivot. But he was saying maybe they have to stay higher for longer. And the reason is because it's going to take a long time to get inflation under control. And we get core PCE number tomorrow. That's going to be fascinating.
Yeah, Gabriella, you're shaking your head in agreement with what you're hearing from Stephanie Lay?
It's just such a hard pivot to say they'll finish hiking rates in December and start cutting in the first half of next year when we have headline PCE tomorrow likely coming in 3.5 times above the Fed's target of 2% and taking us the better part through 2024 to get back to 2%. So I think we're underappreciating this idea of getting to higher rates and staying there and the effect that can have on multiples on the cost of capital from here.
Steve, it does the notion seem a bit absurd that the Fed is going to start cutting rates early in 23, given everything that we've heard and those who are going out of their way to make sure we hear it.
Yeah. Hey, Scott, can I just do a nerdy correction on Gabriella, which is that the 2024 forecast, Gabriella, doesn't even show the Fed getting back to 2%. I think they have 2.4 built in. And I know you're on or about right, but I just want to point out, I pointed that out to Bullard. You guys go, look, we'll take 2.4 if we get close enough. That'll be a huge victory. But getting to your question, Scott, you're right. I mean, at the end of the day, the Fed has much more work to do here. And it also told us today, we had a bunch of things like Esther George talking about the idea, yeah, some stuff's come down, cars, hotels, but the broad inflation that's out there has not yet come down. And so she wants to see, we got the first, one of the answers to Gabriella's things she wants more clarity on. George told us she wants 3 months in a row of better inflation to start to feel confident that it is indeed coming down. So that's at least one metric we have out there that maybe would make Gabriella just a touch less anxious.
So the statement you just made, Steve, the Fed has much more work to do here. Is that going to be Powell's message? Would you game that out? Do you think that's going to be the crux of the message tomorrow, that we do have much more work to be done here?
Yeah, Scott, can I call up a full screen from Powell last year where he said incoming data should provide more evidence that some of the supply-demand imbalances are improving and more evidence of a continued moderation of inflation. If you'll note and you remember, that was 5% CPI when he made that speech back in August. It's now, as you know, top 9 and came back down to 8.5. So I think he's going to be very careful not to show very much wiggle room between this idea of the Fed hiking rates and going further and try to provide any ammunition to those out there. Look, it's a really interesting thing. I got a note from one market participant about this notion about the Fed cutting next year. And he said, this person said, the Fed doesn't know yet what it's going to have to do next year, and that is to cut rates. So that's the kind of, I don't know what you call it, prescience or chutzpah, one or the other. There's some in between those two things.
Part of the point we made earlier, Stephanie, is that the Fed doesn't know what it's going to have to do next week. Because how could it, right? You're going to get more inflation data, and it's going to shape, in part, policy, which could make much of what has been said over the last couple of days moot. In some respects. How do you see that?
Right. Well, look, I mean, I think we're in a trading range for that very reason. We rallied up 14% from the June lows because people thought that they pivoted. They didn't pivot. And then we got economic data that was actually not terrible, right? People were talking about earnings were going to collapse in June, and we were already in a recession. And the data that we've gotten since then actually has been pretty good. Mainly jobs, like that's the bright spot, but retail sales, industrial production, capacity utilization doesn't point to a recession right this very moment. And so they are going to have to deal with with this inflation picture, and they can, because we do have higher inflation, but we also have strong jobs. And so, I don't think they know what they're going to do. Is it 3.5%, 4% on the Fed funds by the end of the year? It doesn't really matter, Scott, because rates are going higher. And in that environment, you don't want to own growth names, and you don't want to own long-duration assets. You could own a few of them, for sure. I do. But I think you want to own pricing power stories. I'm loaded in energy, materials. Industrials are caught in a bid as of late. And I've been recently adding to some material names and some financial names, because I think those sectors into the end of the year are going to do better as the Fed has to deal with this impossible inflation.